To our annual Professional Advisor Continuing Education Seminar, presented in a virtual format for the very first time in 15 years. We've been hosting this seminar in conjunction with the State Planning Council, and this is in lieu of their October meeting. We're so happy you could join us today for this important look at market and legislation impacts of planning. If we could go to the next slide. Great. I'd like to thank our dedicated sponsors, Colonial Consulting, the Bonadio Group, Germany, Burke and Brown, Mackenzie Hughes. The next slide, Financial Planning Association of Central New York, Estate Planning Council of Central New York, Ligada, Prudential, and as well as the Society of Financial Service Professionals. Next, I'd like to go over the CE credit instructions. So first, you must complete the mandatory sign-in form along with the evaluation form that was provided to you via email yesterday and this morning. Dara can put that link on the chat right now so that you could access it via chat. You must complete and submit this form by noon today in order to receive credit. If you need more than one type of credit, please indicate so on the form. Please note that the CFP, CLE, CPE, and self-credit have been approved at this time. The CE for insurance is pending approval by the New York State as of now. And Ted Kowalczyk can be contacted if you have any questions regarding that, but that should be, that is in process right now. Just some housekeeping items for the insurance CE. No conduct of insurance or other business should take place during this virtual seminar. The New York State Insurance Department requires licensees to be in attendance for 100% of the approved class hours. Again, I'll be providing the 2 attendance verification codes during the seminar, and you must provide that in the form in order to receive CE credits, and that goes for all the credits. And the course completion document will be issued to each attendee who satisfies the provider's attendance requirements and completes this course. I'm Pragya Murphy, Development Officer at the Community Foundation, and I'll be monitoring the chat box. If you have any questions during the seminar, please send the question to me, Pragya Murphy. All right, let's get started with the presentation. I'd like to welcome our very own President and CEO, Peter Dunn, to get started with the presentation. Peter?
Thanks, Pragya, and thank you everyone for being here and joining us this sunny, clear fall morning. A couple things before we get into the presentation. First, I want to join Pragya in thanking our sponsors. Obviously, we're all pivoting to meet the moment and trying to find ways to continue to move things down the road and improve the community and the way that we work with clients and so forth. So we're really thankful for our sponsors' continuing engagement with this seminar. I also want to make a special point of noting that a number of the Community Foundation's board members are with us today. As I told through the 4 or 5 screens of boxes, I noted that Kara Fay, Grace Gezzi, Karen Delaney, and Lee Gata are with us today, and they're all current members of the Community Foundation's board, and quite a number of former members of the board are also with us today. So I want to thank them for their engagement and role in guiding our work. A couple of quick things, and then we'll move into the presentation. First, obviously, we're living in a time of COVID, and as you no doubt have seen, philanthropy has taken on a new role over the last 6 months. The Community Foundation joined with the United Way, the Allen Family Foundation, other local funders, the city and the county, to create the COVID Community Support Fund locally. We also did similar work working with our regional affiliates in Oswego County and Cayuga County and the Women's Fund to bring funds forward through gifts over the last 6 months that have resulted in more than $2 million in support for local nonprofit organizations. Some of the things that we've seen have included a real stark need for issues as basic as food and personal hygiene items. We've seen nonprofits, I hesitate to overuse the word pivot, but really changing to meet the moment and needing technology to do so, and needing funds to be able to make that happen. And then we've seen some systemic change, trying to figure out ways to continue the work, but in a different way. A good example of that is trying to create new summer engagement programs for youth in Syracuse this summer, when what used to happen just couldn't happen. So that work has been really encouraging. Of the 2.2 million that's been raised, about 1.9 million or so has already been distributed, and that work will be coming to the close in the next month or so. Obviously, we've also lived in a time of significant reckoning around racial equity issues. The Community Foundation this year launched the Black Equity and Excellence Fund, made a $1 million commitment to support Black-led and governed organizations in this community. And I'm pleased to say that within 3 months of making that commitment, we just made our first grants. And you can go to our website and check out the organizations and their work and learn more about how they're helping move the community forward. So we're really honored to be working with those organizations and continuing to do that work in the coming months and years. I'm really pleased to be joined today by Mark and Tara. Mark Penzner is definitely someone who is known to many folks in Syracuse. Mark's a graduate of Syracuse University, where he was at the Newhouse School and was a Chancellor's Scholar there, and makes frequent trips up to his alma mater and is here in the community quite often. Tara Popernick is CFA and CFP, Director of Research and Wealth Strategies, and the Senior Vice President at Bernstein. And together they bring a really great perspective on where we are currently and where we're going, and experience in dealing with charitable and philanthropic planning issues. My role here today is really editorial. I'll be popping in from time to time, particularly on topics as they relate to charitable and philanthropic planning. But I'm not going to be the main presenter here today. Again, thank you for everyone for joining us, and I'm going to turn the program and the screen over to Mark and Tara.
Thanks, Peter. And thank you to the many people who had joined this morning. Tara and I were looking forward to doing this in person, but obviously events over the last 6+ months have changed the reality of the world we live in, our ability to travel up to Central New York, and obviously investment markets and how we think about planning, both in terms of a long-term investment strategy, short-term volatility, and to the topic today, how we're going to think about tax planning and estate planning and philanthropic planning as we enter the end of the year. So our agenda today is talk to you about the markets, where we are today. We'll try and keep that as brief as possible. I think a topic that you're all going to be interested on is Tara sharing our firm's research on the elections, what we think might happen, and what we think the impact would be on things like taxes and how that might impact philanthropy. We'll talk to you about what we think the outlook is for planning, given today's very low interest rate environment. And then we'll pivot to how to think about personal philanthropic planning broadly and in today's environment. So that's the agenda we've got set for today. And so let's start with investment market trends. And I'm not sure I'm going to tell you anything that's not sort of broadly obvious if you turn on the news or go into CNBC or Fox News real quick, because it's clear that where we are today is at a crossroads. The markets today are thinking about what the economy will look like, not today, not in November, not in December, but what things are going to look like in 2021 and forward from there. And markets have been pricing since the worst of the coronavirus, 2020, as though it's the bridge to 2021. Right? Markets are a mechanism for pricing in what's supposed to happen in the future. And so when your clients, because all of us are in the professional environment, ask about, why is the market up so much today? And we can talk about that. It's really about the market not thinking about October of 2020, but it's thinking about where we're going to be in March and October of 2021. That said, I think it's obvious to all of us that there are still a myriad of risks present today, and I'll talk you through them later on in this presentation, but they range everything from the obvious coronavirus, election, to maybe the less obvious, like the interest rate environment, trade policy, and things that are bubbling under the surface. And I think this year, it is a really great test case, and I don't want to say test case because it's been a real life example of how we should advise clients as professionals, whether you're a financial planner, financial advisor, accountant, attorney on this call. We all stress so much with our clients the notion of not trying to time the market. That doesn't mean you're not tactical and think about where to be opportunistic and where to be defensive, but major shifts in a client's long-term plan that we all as planners have spent so much time getting right, underscored in 2020 that if your clients make big changes to their asset allocation at the wrong time, it can be really disastrous for all the good work we've done on the client's behalf. So serious challenges to market timing, and I'll show you in this year why that would have been so challenging. So stocks, as you know, went through as rapid decline as we've ever seen in the first quarter. And just think about where we were. January markets start the year really strong. And then as the coronavirus news breaks, markets fall off precipitously. Now, you know all that, so I don't need to kind of Monday morning quarterback what happened there. But if you look at this chart in the context of this year and this economic contraction and market contraction, in the context of previous sell-offs, look at the speed and the violence of the purple line, that's 2020, versus all other declines in markets of over 5% since 1965. And so typically markets don't bottom for, call it 3, 4, 5 months. Sometimes it takes 6 months to a year from a market to go from its high peak to its trough. This basically happened in 3 weeks. We had never seen that violent of a sell-off. Now, 1987 had the one-day enormous drop. So, but this precipitous decline, right, happens over a 3-week period, and then, and I'll talk more about this in the following slides, basically turns on a dime and recovers to the point where now sitting here 6 months post-March, markets are up 7% for the year. I think if you would have said to most of your clients in late March, early April, oh, don't worry, you're off 30%, but if you close your eyes, you'll be up 7% on the year in your stock portfolio within the next 5 to 6 months, they would have laughed at you, especially given the fear that was in markets, in our clients, and baked into the market. And the fact that in such short order, not only had clients recovered their losses, but had been ahead, right? A client who's 100% S&P 500 this year is up 7% on the year. I think that's stunning to them because of the violence of the decline and frankly, the violence of the snapback. I think one way to think about this is in your mind, and Tara and I have done some work at kind of drawing out this chart, but if you break the world into, and maybe the US into 3 component parts, what's going on the health scorecard, what's going on in the economy, and what's going on from a policy perspective, both fiscal and monetary, so Congress spending and the US central bank spending. And you just put together a scorecard of, hey, is that a positive? Is that a negative? Is that a positive? Is that a negative? On the health, economic, monetary, fiscal policy scorecard, it is going to tell you exactly what has happened in markets and what you should do going forward. Because if you look at the bottom periods of this chart in February and March, this was the height to that point of the fear of the toll of the coronavirus. Now, we don't know what it will be going forward, but remember the fears of potentially millions of deaths by this point in the US. And so the health outlook at that moment in time was downright scary, right? It was as negative as you could think about. The economy was in free fall and we didn't have policy responses. And those things combined have a market down as far as you see on this chart in virtually weeks. Once you started to get fiscal policy and monetary policy on the table with the CARES Act, with Jay Powell and the US Central Bank really buying everything they could to support markets, the bottom was set. And then as the health data got better, I'm not going to tell you it's good, but better from the worst fears, and the economy started to level off, and we had continued policy responses, you got the recovery you see on the following chart. And where we stand today is as we talked about at Crossroads, a period where I think it's fair to say the health outlook is unclear today, right? How much, look, we know we don't have a vaccine tomorrow. So when we think in broad terms, you know, the perfect health solution would be vaccine release tomorrow. We don't have that. And the negative would be, you know, an enormous spike. So I would say we're very dependent right now at a crossroads of where we'll go on the health scorecard. We'll talk more about where we are in an economic viewpoint, but we think we're off the lows. And we clearly have policy response from the US and central banks around the world. And there's clearly debate today, literally today in Washington, about what will be the US's fiscal continued support of markets and the economy. If you kind of say, okay, here's what I think is going to happen on the health perspective, it's going to get worse, it's going to get better. And if you just watch the news flow, good data about vaccine, bad data about case counts, markets respond to that. And if you look at the negotiations in Washington, hey, it looks like we're going to get a deal, more stimulus, or we might not, markets respond to that. So we're at a point in time where markets, I would say, are very data dependent about the future outcome of the health crisis and the future outcome of fiscal policy. We know Jay Powell and the US Central Bank are all in, and we kind of have a pretty good feel for where the economy is today. And so what that meant is that in second quarter, as that bottom got set, you had across virtually all markets on the screen, whether it was equities, credit, bonds, government bonds, or alternatives, enormous snapback in terms of return. And I think because people and many of our clients really weren't focused on the market in second quarter, they were focused about their children, school, their own health, their family members, right? They kind of felt the pain of the market on the downside, but in some ways, I think just missed, not financially, but emotionally, the returns that have happened post then. This is just second quarter data. I know we finished third, we're gathering all this data now. But in second quarter, markets in the US were up 20 to 25%. That rally continued into third quarter. Foreign markets were up 14 to 18%. Credit markets were up high single digits to double digits. Government and municipal bonds, which had sold off, rallied all the way back. So across the board, return. So what does that mean for sentiment? Well, on the left side of this chart, right, there's a whole bunch of ways you can price in options markets. Are markets bullish? People think they're going to go up, or are they bearish? And today, as of the end of June, and you still see this today, the sentiment in options markets is fairly bearish. You can actually, we've done some research around, and Tara's team has done some research around the election. She'll talk more about this, about what options markets are pricing. And people are just worried, not about election outcome, but what markets will do around the election time. So more on that with Tara. What I find so interesting is the chart on the right. This is global cumulative weekly fund flow. So what does that mean? That means where is money going across asset classes? Is money going into the stock market, out of the stock market? Is money coming into the bond market, out of the bond market, or cash? And if you look, the first part of the year started fairly boring, right? Money slow, because wealth is created in this country. Money is coming into money markets, cash, money's going into the bond market, money's going into the stock market, and then the crisis happens. And all of a sudden, you can hear a giant sucking sound of money coming out of the stock and bond market and everything going to cash. And that really peaks in terms of the rapidity, but it has continued in late March, early into mid-April, which was the exact wrong time to be selling your stock and bond portfolios out of fear and loading up on cash. Those cash levels have really not come down as we sit here today. Stock levels in terms of purchasing, fund flows, as you can see in the green, have really not moved in any material way. Bond flows have come back a bit. And so this really underscores the notion of market timing and the importance of all of our collective clients trying to stick to the long-term allocation that all of us spend so much time putting together for them. So Tara and I put together this chart, really kind of a play-by-play of this year with major news events on it. And just as a proxy, right, I would think most of our clients are not 100% stock. When I say our clients, I'm not speaking to Tara or myself or Bernstein, but most investors have some mix of stocks and bonds. So as a proxy for a model portfolio, we chose to use a 60 stock, 40% bond portfolio for this chart in this example. So here's the timeline of $1 of growth, whether your client has $10,000, $1 million, or $10 million. Here's what happens, right? Markets start off the year really actually pretty good, and then we start to get news about a lockdown in China. Italian cases surge. South by Southwest cancels, and now the markets start to really rapidly decline. Where that red line going across is if your client, at the point in time where first the president addresses the Oval Office and talks about blocking European visitors, at the point where the US declares a national emergency, the client with $1 in the market, $1 million in the market, $10 million in the market, had roughly at that point in time 88 cents on their dollar. And if they said, you know what, this is not good, I've seen all of these things happen in the news, the US has declared a national emergency, I'm getting out of the market. It is absolutely true that from that period of time in mid-March to the bottom at the end of March, where the Federal Reserve starts to cut rates, New York City and California schools close, that client who's 60-40 would have avoided the pain of that dollar, which had already fell to 88 cents. They would have locked in that bottom and then missed a bottom that brought them down to about 76, 77 cents on the dollar. So no doubt, going to cash when we declare a national emergency as a country would have protected the losses and would have felt great. But here's the thing, the market snaps back so fast with the stimulus bill, with the peak in our home state, New York, and then vaccine trials starting to get announced, that if you look at where that client would have been at the end of June, let alone now, they would have been more than ahead of their $1 invested. The client who sold out, feeling really good about it, getting out of the way, reacting to all of that visceral fear, still has 88 cents on the dollar. So if your clients can get through those periods of emotional and to some degree financial crises, they're going to be much better served than if they try and react to the news flow. Usually this chart takes longer to play out than it did this time, but it is really important that we tell clients that, hey, you've got to have a plan that you can live with in the long term. And the best way to think about that is, we would rather, Tara and I, have a client not be 60-40, but be half stock, half bonds, or 40% stock, or 30% stock. Whatever it takes to make sure they're not a seller at the bottom of this purple chart, because if you're a seller at the wrong time, you can never get back in at the right time and recatch the lost gains that you missed. So we think kind of ensuring a portfolio to the level of comfort is critical. So the question we often get is what sparked the recovery? And it's a handful of things, all of which we tried to put some graphics around it just so that as you talk to your clients, you have some kind of visual in your head about this. The first, and I've talked about this, is the response from government. Fiscal stimulus. In the global financial crisis of 2008 and 2009, right? Not only are our clients' home values falling, but portfolio values are falling. It took government about 2 years to get $2 billion of support. We did $3 billion of support in 3 months. The unprecedented speed in which governments responded really put a floor in the economy. Okay. And concurrent to that, on the top right chart, again, compare the coronavirus to the global financial crisis, the Great Recession of 2008. Fed funds rates were at 5. It took a few years to get them down to essentially 0. In the coronavirus, Fed cut rates from 2 to 0, not overnight, I'm exaggerating, but again, in a matter of weeks. That was not only in terms of quantity of support, but the speed of that support was by any measure unprecedented, and it really put a floor in markets. The US government has done everything like support off-the-run treasury bills to support the normal auction of the treasury markets. It has injected tons of money into the U.S. high yield market, buying both individual issues and ETFs. These are effectively unprecedented steps to support economies and markets, and so far it has been successful. The other thing that happened on the bottom left, and I'm not going to get too much into this because I'm not a scientist by any means, is case counts, at least through the second quarter, had slowed down. We will see where they go from now. In my visual, in our mind, health, economic, and policy. I think the health is a question mark today, so we're going to have to think about how the bottom left numbers evolve. And there is a real vaccine timeline. There are lots of companies with legitimate shots on goal, we describe it, to bring a vaccine to the market in the coming weeks, months, year. There'll be some supply chain challenges around that, right? You can't vaccinate 300 million Americans, let alone the globe, overnight. But from a market perspective, remember I talked about markets think forward. The news that we have a real viable vaccine, when that comes, markets are going to start to price in, okay, now I know I can get back to normal in April, July, October. You pick the point, but as the market can see to that end date, it gets a lot more certain. Here's what we know. Markets hate uncertainty, whether it's about economies, elections, trade, anything. Right now we have uncertainty. The vaccine being approved, developed, that eliminates a giant sense of uncertainty to the market. The market can price in a timeline. What it doesn't yet have is a definitive timeline. This vaccine will give us a definitive timeline where all of a sudden everyone across the street, all of our financial markets, all the financial modeling can get a real handle on, okay, here's what's going to happen. Here's what my earnings forecast is going to be. Here's the impact on the market. Here's where I should price stocks. Until we have that, it gets much more volatile because we're dealing in a highly uncertain world. And in that world, earnings estimates are at times a guess. And so let me walk you through how Wall Street collectively revised its earnings estimates for both this year and next year. And I'll try and make the connection to how that impacted the price of the market and the declines. So earnings per share, right? In 2017, were 131. The following year, 2018, 159. 2019, 162. We have an economy that's steadily moving forward. In 2020, the estimate was that markets continue, I shouldn't say markets, companies continue to be profitable, earnings continue to grow across the market, and we go from 162 to 177. And in 2021, we go to 195. That's consensus, right? So the consensus was economy's moving forward. All of a sudden, earnings come down to 125 in 2020. Boom, crater. And that's got to be reflected in the price of stocks. Now, I said earlier, this is all about the bridge to 2021. Well, a few months ago, the estimates for 2021 earnings were $140 a share. That was basically back to 2017, 2018 levels. And the markets reflected that. As that bearishness has passed and we have clarity as to, I shouldn't say clarity, some degree of clarity as to how the economy has responded. Remember, we were at a point 6 months ago where basically the US economy was shut down entirely. It is very reasonable to be terribly bearish about your earnings forecast when the economy is shut off. Now that we've reopened the economy, and we can debate about the degrees of that, but we have economic activity again. We'll show you that in the following charts. Those estimates have come from 140 back up to 162. So the economy next year should basically look like the economy in 2019, or earnings in 19 should look like it did in 2021. Still way down from where we were forecasting without coronavirus happening, but a heck of a lot lower off our bearish, and when I say our, Wall Street's collective bearish estimates. And that move from 140 to 162 is a lot of the reason why stock prices rebounded. So we built this chart that basically is a heat map that says, okay, you pick professional advisor, you pick client, you tell me what, and I know most of our clients can't do this, but it's a way to kind of walk them through what their best, most optimistic and fears are. You tell me where you think earnings are going to be. Do you think earnings are going to be $130 a share, which is going to be back to 2017 levels on the left? You think it's going to be 182, which is, you know, pretty on track with what we thought it'd be prior to coronavirus. And then you tell me what the multiple is going to be. Is the multiple going to be 13 times, 20 times, 17 times? And I'll tell you where the market should be. Should it be flat, down 30%, up 20%? And you can kind of just tell a client, look, this is what you're pricing. I know markets aren't always rational, so when markets are moving, you can put them on this chart. At the trough, the bottom, the market was down 30%, which is what we're circling on the left. That was baking in the worst case scenario of 2021 estimates, where markets or earnings per share were in the 130 to 140 range, and earnings per share were 15, 16, 17. Again, you pick where you want to be on that chart. When you get to where we were at the end of June, and it's even better today, with earnings looking a heck of a lot better, now you start to move into the green on the chart, and you pick what you think the multiple should be, and that tells you where the market is going to be. Now you can debate whether or not that multiple is overly inflated and markets are running too hot, or if they're too cheap. But now you can put this conversation in the context in a really rational way with your clients. What do you think people's willingness to buy the market's going to be? That's the left. What are they going to pay for the earnings? And on the top, what do you think the earnings are going to be? All of that said, we're in a period of risk, right? I mean, you pick whatever you want. COVID cases, US-China relations. The pace of rehiring matters. How do owners of companies, both large and small businesses, feel about spending their capital to put people back into the workforce? What has the impact of technology been on the need for labor, right? Can we run these businesses with less labor? It's a real question that I don't think anyone has the clear answer to that. So what's the impact of technology going to be? What's the impact of this Zoom going to be on business travel? And what's that going to have as an impact on the airline industry and the hospitality industry? You know, these are all things that I think are not so clear that we have to think about beyond the big topics like future fiscal support. Again, those negotiations in Washington today. How is the Fed managing interest rates? So there are a lot of things on our plates, our clients' plates, to give them anxiety. And I think all of our jobs as advisors is to recognize that for our clients, and then try and also balance that with what the client's long-term goals and objectives are. Just to sort of tangent on philanthropy, if you're a foundation and you're thinking about supporting the community for the next 50, 100, 200 years, you know, that's a financial challenge, right? And that's one equation. On the same token, clearly there's fears about losing money in the current environment. And our job is to build plans that think about that short-term volatility, but don't take the eye off the ball of this foundation's got to exist in perpetuity, where this client is worried about retiring with all of these risks, but they're 65 years old. How do we build enough return in their portfolio so that they're fiscally healthy and can live this lifestyle they want at age 75, 85, 90, 95? That's the balance here. And so we've got to acknowledge those risks, both short and long term. The risks today, the economy is opening up. Progress is going to be bumpy, and it's going to be in different sectors. There's a whole bunch of new data that you can see on this, whether it's what parts of the economy are rebounding. I mean, look, you guys know a lot of this data. If you're in the restaurant industry, your data is not great. If you're in the airline industry, your data is not great. So look on the top left. This is credit card spending year over year. Restaurants don't look great. Groceries do. Just think about your own lives. This isn't surprising, right? People stopped going out to eat and bought everything on the shelves of every price chopper in America. So it's very hard to take these big macro views. You've got to kind of think down on the micro level. You can't just say, you know, food, groceries look different than restaurants today. TSA travel numbers just collapsed. They're slowly moving up, but clearly are a really challenged number. Tara and I live in New York City. Subway usage, empty. And so how people are moving around is important. Now, if you look at the Amazon and Google travel data, and you overlay their travel data versus New York subway usage, it looks entirely different. Meaning, if you live in a car like Syracuse, Rochester, Albany, most of America, people are driving again. if you live in a mass transit city, travel's really restricted. Not because of lockdown, just because people don't want to be in sardine cars on New York City subway station. And so, you've got to be very nuanced about how this data looks. We looked at Las Vegas casino traffic down dramatically. This is by casino, slight uptick towards now, but again, really tough numbers. And the thing that's going to offset that is what I talked about before. It's policy making, right? These charts get more technical, but on the left in the blue, on the top, it says central banks were tightening monetary policy. And on the below the line in the blue, it means they're being accommodative. And the orange is basically global interest rates. So what do you see? Basically, globally, most central banks around the world a year ago were pulling back on stimulus. Now they're basically all pedal to the metal supporting global economies. This is not just a US phenomenon. On the bottom left, you can see security purchases. So going into the market outright and buying securities. Not only do we have the Fed here, but we have the Bank of Japan, the ECB. And you can see, obviously the US is the biggest player in this, but 12 months ago, central banks were contracting their balance sheet, and now it's all the way the other way. I mean, and it is so much bigger than 08. If you think about, people would say, oh my God, we spent all this money, not only US, but globally in 08. How do we deal with all that spending? Look at what the mountain looks like now versus what it looked like in 08. So what's the impact on recovery? Our chief US economist at Bernstein yesterday revised this forecast, but it's very similar to what you're going to see on this chart. So the green line is the typical sort of straight line growth of what we were projecting the economy to be prior to coronavirus. Okay, so we had a slowly growing economy. That's good. Our initial forecast was straight down and a challenged recovery up. That forecast in the blue and the forecast that Eric Winograd, our chief US economist, released yesterday is very much the same slope of the blue line, but it's a little bit sharper now. So the economy is doing better in 2020, and the recovery in 2021 will be a little bit more of a flatter line. But on margin, we're doing better than the initial forecast, and the blue line today would be a little bit different shape, but higher than it was in as of this writing. The gap, though, is the kind of permanent loss in the economy, right? If you didn't take a business trip this year, or travel with your family, or go out to dinner, make this up. If you skip 10 meals out to eat, you're not going to go out to eat 10 more times in 2021 to make up for those. If you said I take 2 family vacations a year and I didn't this year, you're not going to take 4 next year to make up for that. So in the simplest terms of think about it, there is some permanent loss in the economy for things that didn't happen. Now, there is an increase in spending, but some of that is that permanent loss, and that's the gap between the old dot line versus the new forecast. From a very specific stock market perspective, less about the economy, I think we all know, because we're in this business, the market has been led, but I'm going to show you some charts to put some data around this, by the FANG stocks, by tech. Very broadly, FANG stocks were up 45% at one point for the year, while the market was flat. And clients would say, well, why is the market up 5% through today? The answer is because of the FANG stocks. If you back out the FANG stocks from the market's down. Think about that. So the market is not really reflecting the overall economy. It's not really reflecting Main Street. It's reflecting pricing 2021, and it's pricing mega cap tech doing amazing. And if you just look at the Russell Growth Index, 1,000 stocks in the Russell 1000, the top 5 stocks, Microsoft, Apple, Amazon, Alphabet, Google, and Facebook, make up about 36% of the Russell 1000. So even the growth index has been really all captured by 5 mega cap stocks. By the way, in the global index, same thing. The US has done so much better than the rest of the world. The US is running almost 70% of the global index. So quick few slides on this. Just to amplify it, if you look over the past 5 years, this technology story hasn't just been this year. It's been a 5-year story. Technology is up nearly 60%. Basically, the rest of the market is flat or down. Healthcare, industrials, financials, energy, they're all down. Technology and mega cap tech's up a ton. It's not just a coronavirus story, although it's more pronounced this year. It's been going on for 5 years. And those top 5 big stocks now make up more than 20% of the S&P 500. If you flip ahead, just to highlight this, even in 2020, if you look at technology, tech is up 15, discretionary is up 7, but that's really just a proxy for Amazon. Everything else is down. So the question for investors going forward is, does this normalize or does this trend continue? What I would say is, in the bigger context, what we should be telling all of our clients is have a plan and stick to it. I'm showing you on the following slide what our forecast was in 2015 of June. So 5 years ago, we told clients when we were building financial plans for whether it's an endowment foundation or a retirement or a charitable trust, we said, expect in a regular market a 5.2% rate of return. If markets are great, you'll be on a 9% path. If markets are really hostile, you'll be at a 1% path. Net of fees, and this is a Bernstein chart, we're basically right on our forecast of 4.5% versus a typical market of 5.2. So given all that volatility, if your clients can take a 5-year plan, at least a 5-year view, they're basically right where we thought they would be. So here's how we tell people to navigate now. I don't think there's anything, revolutionary here, but we do want to do a lot of planning with clients to get the asset allocation right. And part of that is we want clients, whether they're high net worth individuals or foundation or endowments, we want to calculate for them what's the amount they need for whatever it is they're trying to do. That's their core. If they have surplus capital, to think about their surplus different and think about the investment strategy for surplus differently than core. And to be really intentional and thoughtful about how those investments are made. We want to be thoughtful about clients who have either accumulated cash over a long period of time, may have just gone through a transaction, sold the business, or sitting on cash, want to get a financial plan in place, but are hesitant given the market. We want to have really thoughtful discussions about how to do that. We want to think about how you build portfolios that the risk mitigating assets, the bonds truly are risk mitigating in an environment that is really unique, especially in the municipal bond world. We want to make sure return seeking asset stocks are really very broadly diversified and are thoughtful about this FANG issue. And lastly, for clients who this fits the profile, we want to be really thoughtful about alternative investments, because when you have big market dislocations like we've just gone through, it does present really interesting opportunities that are not just traditional stocks and bonds, to have a diversified investment strategy in alternative investments that can reduce the volatility and also potentially increase return. So let me stop. That was long. I apologize. And Pragya, are there any questions? Otherwise, we'll talk about the election with Tara.
We do have a couple of questions, but before I do that, I just want to provide the first attendance verification code that's required for the CE credit. It's SMART Money, SMARTMONEY, SMART Money. You can fill that in on the form. And the first question, Mark, is regarding the election. So the question is, in the event that Joe Biden wins the presidency and Democrats keep the House and gain the Senate, with their ambitious spending plans, what would they recommend, or what would you recommend in terms of investment strategy? What do you think will happen with interest rates?
So I'm just going to punt on that because that's going to be the next section. So I'm not avoiding it, but Tara's got an awesome deck to walk through that exact question.
Sure, great. And there's one more question. Do you want to take this? I think this should be pretty relevant. Any thoughts on products that will deliver positive cash flow for our foundations that have near-term funding commitments?
Yeah, so yield is a challenge today, and Tara may speak to that as well, because she's been on some of the product development work that we've done as a firm. Depending on the nature of the foundation, right, and their ability to take on illiquidity, it sounds like this question, the foundation may not be able to take on illiquidity. But if a foundation or a high net worth investor can live with illiquidity, we think there are really interesting yield opportunities in both the private lending market, broadly speaking, middle markets lending, and in the real estate / mortgage space. So if a foundation or a high net worth investor can tie up some capital, there, in our view, is really interesting opportunities for yield. Let me also add to that. Now, this market is much more liquid, but it does come with what we call mark to market, so price fluctuation. We think the high yield market, if you're a foundation, as the corporate high yield market, if you're an individual investor, both that market and the high yield muni market is attractive for yield on a risk adjusted basis. I say risk adjusted because there is clearly risk in that market. If your time horizon is because you have an upcoming project, whether as an individual or a foundation, in the next 6 to 12 months, unless Tara's going to say something different, my view is it's very hard to get any reasonable rate of return with no risk on your paper today. And I think the word of caution I would give is do not stretch for yield. I would rather accept the terrible yields you can get in money markets today than really risk capital to get 1 or 1.5%. I think if you're going to try and get yield, you try and get a whole bunch of it and you accept that risk and the time frame, but I wouldn't do much to, you have to take on a lot more risk to get to 1 to 2% return.
Okay, thank you.
Okay, so moving forward to the election impact, and I'll start here by saying, first and foremost, we are not political scientists, we are not pollsters. We are here to look at this from an economic perspective and really focus on what the data is telling us from both a volatility perspective and also historical returns perspective. And then what we see going forward as the potential for what could happen. So I will get to the question of, what we're telling clients in the wake of a potential, divided government scenario or a Democratic control scenario, or even a sustained Republican control scenario. So look, everyone says it's different this time, but if you look historically, and this is going back to 1937 for presidential terms, there's very little relationship between the party in power and the results in the US stock market. So this is based on the Dow returns from 1937, under the Democrats, right around 9.2%, under the Republicans, 9.1%. Not hugely different under a divided government versus a unified government scenario either. So there's not a ton of relationship here between political power and the stock market, but how can we think about the potential market impact of our upcoming election? So what do we know? First and foremost, the balance of power in the White House, the Senate, and the House will affect the economy and markets, mostly because the Senate and the House hold the purse strings, right? They can inject more fiscal stimulus into an economy that may sorely need it, depending on how quickly this recovery continues. Also, the White House has the ability to nominate, and then the Senate to confirm individuals to the Fed, which will drive our monetary policy and the philosophy behind that monetary policy going forward. We know what the current polls are saying, but I'm going to dismiss that mostly. And we really have been trying to counsel clients not to let their personal political views cloud their investment judgment. If we look back to the last election, there were individuals who said, if this goes one way, I need to sell everything. If this goes the other way, I need to sell everything. And in fact, the market rebounded shortly after the election. What we know is how closely election results will match the polls. We don't know what the specifics of policy proposals are going to be and how they're going to compare to campaign platforms, and how much they'll change as they're debated and voted on. I think anybody who was around at the end of 2012 when we were about to fall off the fiscal cliff remembers we had no idea that we were going to come out of that with taxes, especially estate taxes, looking did in January of 2013. So how much these different election results or policies are going to impact the markets are already really being factored in. So we're just not sure how much the market sees. So on balance, we're not recommending any tactical allocation shifts driven by election handicapping, but we are working to ensure we're taking advantage of any market mispricings or dislocations that may be occurring while minimizing downside risk to any individual event. So past history tells us that markets tend to ignore politics until about a month before the election. In here, we're looking at the correlation between the polling spread and stock price changes in January and September of an election year, and then from October until the election. So the average from 1996 to 2016 shows that, yes, the market starts paying attention in October. And this is particularly heightened in a couple of cases, but I think 2008 we've somewhat dismissed because that additional volatility was really about the global financial crisis. And then 2000, the only place where we did not see this uptick, that was much more about the end of the dot-com bubble happening in the markets. And so the market was not really correlated to polling. It was much more correlated with the news on what was going on with some of those companies. So right now is the time when we're going to start to see the impact of the election in stock market pricing. So we currently expect some unusually high volatility into November. And some of that is a bit of anticipated uncertainty about when the election result will be known. You know, we know that due to coronavirus, many people are voting by mail. Mail-in ballots take longer to count in many cases. And so we think that some results, and this is really based on our observations of what happened with primaries, some results may take more time than November 3rd. We may not know until the end of that week or the following week exactly what the results are. So, you know, here we're looking at this implied November 2020 move, and we think that the daily price changes are, you know, going to be much higher than they might have been in the last couple of elections or even over the last 30 days. But really, when we think about go forward policy, and this is taking a much longer view, we want to understand how the outcome of the election might impact fiscal and monetary policy. And this is getting to the point earlier about who holds strings. So under all scenarios, we do not think that the control of the House of Representatives is going to change. The math just isn't going to add up. It's going to stay under Democrat control. So we have laid out 4 scenarios: Republican White House, Republican Senate, Democratic White House, Republican Senate, Republican White House, Democratic Senate, and Democratic White House, Democratic Senate. So I'll start with the everything stays Republican in the upper left-hand corner. You know, under this probability, we see that fiscal policy will remain expansionary. Fed will probably shift in chair. We do think that monetary policy will remain easy. So this is probably going to be one of the better outcomes for the market. I'll then focus on the full Democratic sweep, which is in the lower right-hand corner. Here at Democratic White House, Democratic Senate, fiscal policy will remain expansionary, but potentially with some corporate tax hikes. Now, as part of our research, we talked to some policy folks from the Biden campaign. Their position is we're only going to do tax changes as part of other legislation. So whether it's a stimulus package, a coronavirus relief bill, or what have you, that's where tax changes are going to come. They're not going to push through one large tax bill. And that is, sorry, something popped up, so I can't move my slide. The Biden campaign saying that they're going to have to negotiate potentially, and they're not going to get Democratic senators, some of whom might be up for re-election, to sign on to any big sweeping tax changes. So I think that the stated rate of a potential 28% corporate tax rate is probably the high watermark for what could happen there. And we don't think that the market impact is going to be that bad with a corporate tax hike of a modest amount. We still think that the Fed will have easy policy under that scenario. The parts that we're worried about are the divided government scenarios. And here's why we're worried about them. The economy still does need a lot of stimulus. And so if we end up with a Democratic White House and a Republican Senate, we think that the Senate is going to rediscover some fiscal austerity that maybe they've put aside over the last 4 years. While the Fed will maintain easy policy, we do worry about the fiscal side. Then if we have a Republican White House and a Democratic Senate, there could be the opportunity or the potential for some stagnation there. And so maybe we don't get the fiscal relief that we really do need in the economy to keep it moving forward. So these competing visions for the future, and this gets into kind of the brass tacks of what the Biden campaign has proposed versus the Trump platform. I mentioned already the partial reversal of the corporate tax cuts, raising them from 21 to 28%, and implementing a federal minimum tax. There's the potential to increase the marginal tax rate on high earners from 37% to 39.6. What that's really doing is pulling forward the sunset of the Tax Cuts and Jobs Act into an earlier year from the end of 2025. The one I think we've gotten the most questions about is the concept of potentially taxing capital gains as ordinary income for earners who have more than $1 million. And so while this may not affect that many people broadly around the US, this is the one that we've seen mostly in the headlines as the idea that a long-term capital gains preferential rate would go away for those top earners and they would be taxed on income over $1 million, the same as they would be taxed on ordinary income. On the trade, Democratic platform would reduce tariffs. This is probably the biggest difference, reduction in tariffs versus the Republican platform to use tariffs aggressively. Democrats wanted multilateral trade agreements with many countries. Republicans are focused on bilateral trade agreements, so sort of individual deals with individual countries. More onshore pharma and electric vehicle manufacturing, more onshore supply versus more onshore supply chains on the Republican side. Healthcare industry, an expansion of the Affordable Care Act versus a repeal of the Affordable Care Act is probably the biggest difference there. Lowering the Medicare age to 60 from 65 versus work requirements and caps on block grants for Medicaid. So the healthcare industry may be somewhat disruptive. And then infrastructure and the Biden platform. And here's where I think we're going to, as we've discussed with the Biden policy team, see some of these tax increases is to pay for this $2 trillion infrastructure plan with emphasis on public transportation, electric vehicles, and clean energy technology, versus the Republican plan, which is less clearly articulated at this point. But that's policy. What might this mean for specifically the markets? And here we look at, again, those 4 scenarios that I had outlined prior. So, blue wave, two divided government scenarios, and a red wave. Under either a blue wave or the Democratic Senate, Republican White House scenario, we expect stocks to be pretty neutral. Blue wave would, yes, it would bring higher corporate taxes, but you might have some reduction in trade tensions, which would help the market. On the Republican White House, Democratic Senate side, there might be some agreement on some stimulus, but other policies might face gridlock, and we would expect trade tensions to remain elevated, which has negatively impacted the market in the back. So on balance, broadly neutral. If we have a red wave, that's also somewhat positive for the stock market, because corporate tax hikes would be off the table. You'd probably get some additional stimulus and maybe some additional infrastructure plan. So that would offset some of the potential higher volatility from trade tensions and broadly be positive, which is what we've seen so far since the Senate and White House have been in Republican control. We're worried about the Biden plus a Republican Senate would result in a gridlock scenario, and that is going to stall up stimulus, make the plan more difficult to pass, but also harder to pass some tax hikes that might be needed to pay for things that money that we've already spent both on coronavirus relief and on tax cuts over the past few years. So what about bonds? Rates broadly either neutral to slightly lower across the board. Inflation under a blue wave scenario, slightly higher amount of stimulus. Under Trump plus a Democratic Senate, also slightly higher given the amount of stimulus. Under Republican control, higher as well. Credit headwinds, if we have a Democratic White House, neutral to a tailwind with a Republican White House. And for munis, definite tailwind if we get a tax hike. That, I'd say, for our taxable investors is probably the most important thing to consider, is how they're positioned in their bonds should we end up with a little bit of a spike in taxes. So, what are we telling our clients? Not to do anything tactical right now. This is taking a look at how market timing based on politics can really hurt growth over time. And this goes back to that data we shared from 1937, growth of $10,000 invested in the Dow. If you invested only during a Republican presidency or only during a Democratic presidency, you'd be far worse off than if you just remained invested at all times in the stock market. So we're telling our clients to really stay the course. The only thing that they may want to consider from a tactical perspective are things that could potentially happen to wealth planning and to individual sectors. So the individual sectors is where our portfolio managers are focused. Let me just cover that. Under certain scenarios, profits may rise or fall in various industries. If we have either a blue wave or a red wave, and under both scenarios, infrastructure spending goes up, the construction and engineering, education industries would both be beneficiaries. Potentially renewables under a Democratic administration, or there'll be additional stimulus there. So that's a positive outlook for renewables, less positive outlook for renewables, but more positive outlook for oil and gas under a Republican administration. Health insurers, it's broadly mixed. And that is really dependent on exactly what the policies are and how quickly that happens. Pharma under a Democratic administration, we think might be down, just given additional regulation. And I think it's somewhat mixed for technology across the board. So, really a lot of uncertainty, but here's where we're looking to each of these sectors, looking to the policies and trying to find the places where there may be mispricing or things that we can take advantage of within portfolios. Wealth planning is probably the question that I'm answering most often right now. So planning for potentially higher tax rates is likely to add more value than any kind of tactical trading in the portfolio. On the tax management side, in a typical year, we're very actively looking right now to tax loss harvest in portfolios to defer taxes into the next year. But if the next year means deferring taxes into a potentially higher rate environment, and what people are really concerned about there is the potential for retroactive tax increases that go all the way back to January 1st, 2021. There is precedent for that. So we do think that it is a possibility, even if it's, somewhat uncertain at this point. So do you, if there is a Democratic sweep, just cease loss harvesting in the portfolio for this year? The answer to that question may be yes. for certain clients, gain harvesting may be a good idea. And who we're looking at is that target population with income over $1 million. It's not all of your clients, it's some of the clients, and it's some that may be facing a gain in the near term anyway. So we're looking at folks who might be holding a concentrated position of stock that they were intending to divest over time. Folks who might be wanting to make a risk allocation shift in their portfolio anyway by trimming their stock portfolio and adding to a bond portfolio or adding to an alternative portfolio to mitigate risk. Maybe pulling forward those decisions into 2020 versus making them in 2021 is going to be helpful. Going forward, we think from an asset allocation strategy, tax efficient assets and strategies will benefit. So tax deferral into retirement accounts should taxes go up becomes much more attractive. Municipal bonds become more attractive. Insurance and annuities, including for our kind of high net worth clients, private placement life insurance and private placement variable annuities become more attractive. Private equity and alternative strategies with long holding periods that may not be passing out gain for many, many years, so you're getting additional tax deferral, will be attractive. Passive management in the form of ETF for large cap equities, and potentially even doing a strategy like a index replication where you buy 300 of the S&P 300 share stocks in the S&P 500, and then you tax loss harvest along the way. That's going to be really a particularly attractive strategy for U.S. exposure for clients who are on that top end of the wealth spectrum. Charitable giving of appreciated positions, and I'll get into this a little bit further in the charitable planning section, but this is going to be even more attractive than it is today. Going through a portfolio, picking out the stocks that have outperformed, sending those to your charitable organizations, and then replacing that amount in your portfolio with cash rather than just writing the check to the charity is probably one of the best ways for clients to save on taxes. And then estate taxes is this other gray area of potential policy changes, but really we don't have a lot of specifics there other than there is the potential to, again, roll back the expanded exclusion that was created by the Tax Cuts and Jobs Act, and potentially even do other things to the estate tax regime, like eliminate the step up in cost basis, which may upend some of the planning that clients have done here to date. So with that, I'll take a pause and answer any questions on the election before we move to the investment outlook.
All right, I think we're gonna keep going for the sake of time and
Sure.
hold the questions towards the end. Thank you.
Sure. Okay, Mark.
Yeah, so one slide I think captures the entire investment outlook, which is to say bond yields are really low and the market is pretty high. And those two things combined makes it hard to have a really exciting 10-year forecast for investments. So on the top part of the chart, here is Bernstein's forecast for everything from, on the left, an 100% bond portfolio for an individual, so municipal bonds, to a 20, 40, 60, 80, and 100% equity portfolio. Our 10-year forecast for high credit quality intermediate duration muni bonds is just south of 1%. That may in part speak to the earlier question about where do I go to get returns on cash. Our 10-year forecast for stock is only 5.8%. In a normal world, that bond return should be 3 to 4. That stock return should be 8 to 10. And so what it means is that the client who's a 60-40 who thought, hey, I'll make 3 to 4 on my bonds, I'll make 10 on my stock, I'll get 6, 7%. We're now projecting is going to make 4% on over the next 10 years. That's about as low as a number as I've seen. On the bottom, we talk about the risk. And on the left, in the darker blue, we show what's the chance over that 10 years you're down 10%. In the light blue, you're down 20%. In the orange, you're down 30%. In that 60-40 portfolio, we think there's a 77% chance your client loses 10%. So I would say to them, expect to lose 10% at some point for a target return of 4. there's a 1 in 3 chance, 34% chance they lose 20. In Tara and my experience, 20% is a number that is like the most common pain point. Your most risk-taking clients, 30% is the pain point. The more conservative, it's closer to 10. By the way, there's a 1 in 10 chance the 60/40 loses 30%. You go to an all stock portfolio, you should tell your clients over the next 10 years, you will lose 10%. You're probably going to lose 20%, and it's a toss up, you're going to lose 30%. So you've got lower return, higher risk, and that makes really talking to the clients in advance and setting expectations critical. It also means, and like Larry Fink at BlackRock has talked a lot about this, if you're a retiree, you're likely, if you're going to try and make 4 to 5% on your money, you're probably going to have to take more return than you had, take more risk than you had planned, have more stock than you had planned to get there, and have to live to more volatility, more risk to get to your target. So that's the implication. Probably more risk in portfolios, more equity than foundations, endowments, and investors had probably signed on for a decade or two ago. I'll stop there.
Sure. So given that uplifting forecast, maybe we can pivot to talking to some charitable planning more directly. I will note here that all of these numbers very much consider the current environment and what that current environment is, especially from a monetary policy standpoint. So when we're looking at these numbers, and I participate in a lot of these conversations as we develop this forecast, is that we know central banks are going to keep rates low for potentially a very long time, and we're building that factor into this model, which is part of the reason why you reach for risk to get a certain amount of return. So I want to pivot to, what's been the near recent legislative impact on planning. I talked a little bit in the election section about go forward legislative impact on planning, but what's happened over the last 3 years? Over the last 3 years, we've really gotten 3 pieces of legislation that have been hugely impactful on the way our clients plan, and both for their living and for their income and estate taxes. That was the Tax Cuts and Jobs Act, which passed in December of 2017, went into effect January of 2018. The Secure Act, which passed at the end of last year, went into effect this year. And finally, the CARES Act, which was a coronavirus response bill that passed earlier this year. So I do remember actually speaking at a very similar conference at the end of 2017 as the Tax Cuts and Jobs Act was being debated in Congress, and the charitable organizations who were there were fully in belief that this law would dramatically slow giving. And here's a piece from the Tax Policy Center that basically suggested that as soon as that piece of legislation was passed, giving would drop from 37 million of tax deductions to 16 million. And that people would really just stop giving to charitable organizations or slow down their giving to charitable organizations, because given the expanded individual standard deduction, fewer people were going to have the ability to deduct charitable gifts on their income taxes. But what actually happened was dramatically different. Giving increased after the Tax Cuts and Jobs Act. In fact, total gifts went up by 0.7% in 2008 to $427.7 billion. This includes, most of that is done by individuals in the U.S. And I think that what's behind this, is clearly we've had very robust capital market returns. So people are giving more away there, but you've also seen a number of large gifts and bequests by high net worth and ultra high net worth individuals. And here is who is giving and what are they giving to. So a little bit more detail on that $428 billion. The vast majority of it is private individuals in the U.S. and sort of what are they giving to? Really a host of things. Either private grant making foundations at about $50 billion of that, human services, education, religious organizations make up the bulk of the places that people are giving to.
Hey, Tara, I have to admit that, you know, the previous slide that showed the actual increase in giving was completely shocking to me. You know, if we were reducing the number of itemizers from something north of 30% to less than 10%, we're losing a whole bunch of people, middle to upper middle class folks who aren't itemizing anymore. I think your point about, you know, that shift happened during expanding capital markets and gains, and also some differentiation where you had fewer extremely wealthy people giving enormous amounts of money. I think there's also been some differentiation among charities. So those that might rely on a very broad cohort of givers might have been impacted negatively, whereas those that might rely on a tighter group or rely on significant gifts. I don't think colleges and universities were particularly impacted, for instance, those that had big campaigns. But a broad kind of community campaign might be impacted negatively. Yeah, I was just absolutely shocked by it. So.
Right, and I think that shock, you know, was felt much across the board as well in the giving community, and I have seen some organizations really pivot and try to target some of their larger donors for things like, well, you know, hey, you've been writing us a check, could you send us, you have appreciated stocks you could send us, you know, here's our DTC number, you know, we're open to receiving some of these other things, because to us as the charitable organization, it's the same, but to you as the individual, you know, maybe you're getting an additional benefit that either maybe you can't take on your taxes, or this is in addition to what you're able to deduct by avoiding large capital gain. So, you know, some things to consider, you know, since the Tax Cuts and Jobs Act. One thing we've seen some clients consider is the idea of matching their gifts with a donor advised fund. You know, even it not this super wealthy put together, the idea of a donor advised fund is just a very simple way to make all of your charitable gifts in one place. It's administratively easy for an individual. They can then send out grants to the various charitable organizations that they want to support. They can choose to be anonymous with certain organizations if they want to. But from a purely tax perspective, it allows someone who might be on the cusp of using that standard deduction or not using that standard deduction to take full advantage of their charitable giving when they bunch several years of gifts into 1 year, send it to the donor advised fund, and then use the donor advised fund to distribute that money out to charities over several years going forward.
We've seen a significant increase in both growth and donor advised funds, people giving appreciated assets in 1 year, and then not making gifts for 2 or 3 years. So exactly what you're describing, both increase in numbers of advised funds and then increase in activity and use of appreciated assets.
Yeah, and yes, and those donor advised funds are often funded with potentially an appreciated position. You know, we have many individuals out there who might have purchased Apple stock years and years ago, and it's now significantly appreciated and maybe too much of a concentrated holding in their portfolio, but rather than sell it, they can use that for charitable giving. And then finally, the charitable IRA rollover concept really is a way to both benefit from a deduction that you might not otherwise take, since that was permanently made law a few years ago, and also control your income a little bit as a retired person who might have a very large IRA. So I'll go through each of these in a little bit more detail in how we kind of explain them to our clients. This bunching concept, this is just an illustration of, you know, a couple who are, you know, earning some money, but not the super wealthy. They may have mortgage interest of $6,000, state and local taxes, they're capped out at $10,000, and they tend to give about $10,000 annually. If they were to, on the left side of this page, continue with that $10,000 annual giving post Tax Cuts and Jobs Act, they would end up with total deductions of 26,000, just be slightly up above that standard deduction, and really only realize about a $2,000 additional deduction for that $10,000 charitable gift. So, you know, annual tax savings of $740, about $3,000 over 4 years. But if they were to say double up their gifts in a couple of years, they could really benefit by boosting their tax savings, and then in other years take the standard deduction and you know, increase their overall tax savings from around $3,000 to almost $9,000 over the course of 4 years. So that's a big difference. And as practitioners, we can help them with some of this timing. If someone happens to have a large tax event in one single year, maybe they sold a home, maybe they've sold a business, accelerating some of those gifts in that year so they can take a larger deduction might be advisable. You know, finding the most efficient way to give is also really important. And here we're looking at, and this is federal only, so for New Yorkers, some of these numbers get a little bit bigger just given our state income tax, but per $20,000 gift, comparing the alternatives of giving from a charitable IRA, or making a charitable IRA rollover, giving cash, or giving stock that is 25% cost basis. That means you bought the stock for $25, it's now worth $100. So out of all these three cases, the low basis stock is clearly the biggest benefit, in that not only do you get the reduction of, or the avoidance of tax in the form of capital gains, but you also get the tax deduction, such that the net cost to you of making this gift, after you back out all the taxes you won't pay if you're a top rate payer, is only $9,000 on a $20,000 gift. Versus if you're a top rate payer giving cash and you can fully deduct the gift, you are, you know, basically you're using $12,600 in order to make that $20,000 gift. The math works the same on the charitable IRA rollover. It just gives someone the advantage of being able to give that money away and fully receive the tax benefit when they might otherwise not be able to. So we do see a lot of our, particularly retired clients, taking advantage of that charitable IRA rollover. So the Secure Act, which was passed in December, so the second thing we want to hit here, and how this relates to charities isn't exactly apparent at first, but the modifications of the post-death RMD rules have started to make giving your IRA to, or leaving your IRA to a charitable organization potentially more attractive. So all defined contribution retirement plans, both traditional and Roth, must be fully distributed within 10 years of a participant's death, unless an exception applies. And these exceptions are either a non-designated beneficiary, such as a trust, where the old 5-year rule will apply, or what they're calling an eligible designated beneficiary, who can still stretch the IRA over their lifetime. Who's an eligible designated beneficiary? A spouse, a minor child while they're still a minor, someone disabled or chronically ill, or someone fewer than 10 years younger than the account owner. But in many cases, you see account owner dies, leaves IRA to children. You know, maybe the account owner was in their 80s, children are in their 40s or 50s, and children are probably in their highest earning years. So now they're being forced to take out this IRA distribution during a period of time when they might otherwise be at or close to a top tax bracket. The other thing that we find clients don't fully appreciate, especially those with large IRAs, is that the value of that IRA over time is not going to continue to get much larger, especially as you start to take required minimum distributions. So often when we're working with folks who are maybe in their 60s, haven't hit that RMD age yet, they're sort of not thinking about, oh, wait, when I start to have to withdraw 5% from this account, it's not going to grow as swiftly as it has over the last decade. So here I'm illustrating just $1 million IRA with a 70-year-old participant who's going to start taking distributions at age 72 right here. The value of that IRA over time, especially if they live into their 90s, will start to decline because those distributions get so high. So rather than having, probably doubled or more over the last decade, it will be flat from the time that they're 70 to 82, and then really start to decline in value. So someone who might be concerned about, wow, if I give my IRA to charity, I'm really bequesting too much to philanthropy. I'm not striking the balance between my philanthropic goals and my wealth transfer goals to my family the way that I want to. Showing them this chart and showing them that the impact of those required minimum distributions is actually pretty large on the value of their IRA, and can get them over that hurdle of, oh, well, maybe I will just leave my IRA as a bequest. So here, this is another point on illustrating that new 10-year rule and how it can be somewhat cost beneficiary, but doesn't necessarily have to be as bad as you might think. Here we're looking at a $1 million beneficiary IRA, and we're comparing what would happen if someone inherits this IRA and they can either stretch it over their lifetime as a 25-year-old beneficiary, so sort of close to the maximum amount that you can stretch something out, versus adopting the 10-year rule where maybe you leave the assets invested over 10 years, then you take the tax hit and reinvest those assets in a taxable portfolio over time. You see the trajectory of growth between the stretch IRA and the 10-year. It's somewhat lower. This line kind of bends out a little flatter. But remember, this is on a pre-tax basis. If we want to get to spendable dollars, which is really what I would argue many clients should care about, if we take a look at that stretch IRA and subject it to taxes at every point along the way, versus taking money out of a portfolio and maybe paying capital gains taxes on it, the stretch benefit isn't as big as you might think when you adjust for that deferred tax. So here's kind of on a spendable dollar basis what that $1 million looks like after tax accumulation for that 25-year-old beneficiary. So while this stretch seems to be the end of the world for some clients and really seems like it's going to upend their planning, it may be not as bad as they think. Another question we've gotten often from beneficiaries particularly is, should I distribute my inherited IRA as a lump sum in 10 years, or should I distribute it over time? And I would say for a Roth IRA, this answer is really wait till the end of the 10th year because it's tax-free for 10 years, keep it in the account. For a traditional IRA, this research shows it's going to depend on what your income is. If you otherwise, as a beneficiary, have very little income, taking that distribution over the course of 10 years is going to be an advantage to you. If you are otherwise a top rate payer, it doesn't really matter. Maybe leave it in the IRA, and if you do have a sort of a down year in income, that might be an opportunity to take a small distribution in that year. One question that we've gotten particular to the Secure Act and came up a lot as this law was first being discussed is, well, in order to replicate the stretch, why don't we just contribute the IRA to a charitable remainder trust? Make a charitable remainder trust the designated beneficiary of that IRA. So, this would work as at the death of the participant, the assets would be contributed to the charitable remainder trust. The remainder obviously goes to charity when the trust expires. but the annual cash payouts would the IRA be liquidated inside of the trust and reinvested on a tax deferred basis. So basically you're creating a tax deferral vehicle that's much like a stretch IRA for your beneficiary. You know, the question is, do the economics actually line up? And when we took a very close look at this, the answer was, you know, not as swimmingly as it sounds at first blush, because the initial idea was, oh, well, I can create a synthetic stretch by just putting money into a charitable remainder trust. But if I was to compare this to not doing the CRUT, there is some cost. So here we have a $5 million inherited IRA left to a beneficiary. So it has to be paid out over that 10-year horizon versus a 20-year testamentary CRUT, and the personal wealth over time to the beneficiary in the median case, assuming we invested both the CRUT or the IRA, then the individual account, 60% stocks, 40% bonds. Under the no CRUT scenario, that $5 million would grow to 8.8 at the end of 20 years. If we left money to that CRUT and took the highest payout possible of 11.114% on a 20-year term CRUT, there's a slight cost to the beneficiary. The beneficiary still ends up with $8 million, but charity ends up with 1.6 in this case. So,
hey,
you know,
Tara, I was just going to
yeah.
chime in here. Just a couple things, and you may have been wanting to say them, but the thing that strikes me about this is first the 11% payout, which is just like I don't think I've ever seen a CRT with a payout higher than 10, but you know, I'm sure in your own work we always see them in the 5 or 6% range. Mm-hmm. So it does assume some charitable intent, no doubt, when you're working with clients. But I suspect, and you may have some thoughts on this as well, that there are some pretty genuine non-economic motivations, even beyond the charitable impact piece, specifically with spendthrift issues with with heirs and sort of regulating how the assets are used. So it can be to manage how those resources are used by the beneficiary for a period of time, in addition to having a charitable intent. But in those cases, when we've been engaged in these, and they've come up from time to time, we've seen both of those. But we've always seen people who weren't looking at it purely from an economic perspective.
Right. So, and that is a great point, because we are often tasked with looking at these things from an economic perspective as the asset manager. But then there are a whole host of considerations that come into whether a strategy actually makes sense for someone. So, you know, the thesis was pure economics, the CRT is going to be better. That's actually not the case, but it does have a significant place in someone's plan based on totally other factors, just as you alluded to, whether it's, you know, I don't want my beneficiaries to spend through this IRA. I do want to leave a significant benefit to charity. And I think what this shows is even at the highest payout level, you're increasing the total legacy wealth such that both charity and the beneficiary are benefiting. And if we were to reduce this payout percentage, that charity share only gets larger, as does the total wealth. So sometimes we push the limits just to see where the boundaries are, and then find something that works as a better solution for the client. And this is really pushing the limit. You know, another question we've gotten is, what about Roth conversion? And so our research shows that a Roth conversion post the Secure Act can create a benefit, assuming that we don't see a tax rate hike right away. Tax rates stay where they are, Roth creates a benefit now. If tax rates go down, obviously, the Roth conversion was not as attractive. If tax rates go up, the Roth conversion is an automatic home run. And so like looking just at the beneficiary's tax rate, if it's lower than the participant's tax rate, that conversion could become costly. For the participants, particularly to this year though, we have seen several situations where a participant wants to combine a Roth conversion because they're worried about the implications of the Secure Act with a cash gift to a charitable organization, because under the CARES Act, those two things are aligning in order to allow them to basically make a tax-free conversion should they be giving that money directly to a charitable organization.
I was just going to make that point, because we've seen that a couple of times where people have done, you know, very large Roth conversions, and they've offset at least part of that by putting, say, 10 years worth of giving into a donor advised fund in that year. And then they use that as their giving account for previous years, almost like their own foundation. So yeah, we've definitely seen that with multiple clients who we worked with in recent years. And I wouldn't be surprised if we see this this year before year end.
Absolutely. And so that's come up several times, particularly because of the expanded deduction allowable under the CARES Act. Just gonna, key messages on the Secure Act, you know, first, losing that stretch IRA and the Roth IRA has a cost, but not as much as initially feared. The optimal distribution strategy is going to depend on the beneficiary's tax rate. In most situations, CRTs will be unattractive unless the charitable objectives or other non-tax objectives are really prevalent. And so that's a place to explore with clients and find out, you know, what of their goals could be achieved by doing that strategy besides purely economics. And then combining a Roth conversion with a charitable contribution, plus the implications of the Secure Act can all line up to be a very attractive and winning combination. So I'm going to actually skip ahead off the CARES Act. I think the number one thing that came out of the CARES Act is that cash contributions directly to charities this year, not to donor advised funds, not to private foundations, but directly to charities this year, is 100% deductible against AGI. So that is probably the number one thing that we should consider if we're looking at something like a Roth conversion or some other big tax event right now. Do you want to make a cash gift to an organization to help? And this is obviously intended to help organizations with their coronavirus relief by stimulating additional gifts. So I want to hit into some personal philanthropy concepts and really how to talk to clients about some other strategies that might be attractive to them. There's so many, yep.
I'm just going to interrupt 1 second just to give the second attendance verification code for the CE credit. It's SMART Giving, SMARTGIVING, Smart Giving. Thank you. And if you have any questions, please feel free to post them on chat to everyone. So between Peter, Tom, and I and Mark can answer them via chat. Thank you.
Sure. Thanks, Pragya. So look, there are so many reasons why people give. It could be something that they're particularly passionate about, whether it's education or the arts. It could be a specific catalyst, such as a natural disaster, you know, often with hurricanes or, you know, specific to coronavirus, that will push people to give. And then some people like to target specific communities, whether it's their own neighborhood, their own city, their own area of the country, or someplace outside in the world that they really want to target with their giving. This is how they may think about it, and we have to think about it as practitioners along these various dimensions as well. So, you know, some questions we often ask clients to spark their thoughts about their own philanthropic mission are, you know, what do you want your legacy to be? How do you proactively donate? What organizations are you active in? Where are you spending your time? And oftentimes, especially when a client is giving through a donor advised fund, we have the ability to go back and sort of take the answers to these questions down and then compare them to where did you end up sending grants over the course of a year or a couple of years, and are your values and where you're giving money really and truly aligned? And oftentimes we're holding these conversations among family members as well, so that, you know, maybe one generation supports their alma mater and another generation is very concerned about creating economic equality for underprivileged populations, and where the two of them can align is on education giving. So we may be able to create a connection with a client among generations that we otherwise wouldn't be able to connect by getting them to all contribute to the conversation on what their philanthropic mission is. Here's some additional considerations are really timing and family. You know, do you want to see the benefits of your giving while you're alive versus do you want to leave assets at death? Do you want to give to charities every year? Do you like to give large gifts spaced over time? You know, do you want to make a time commitment to some of these organizations and get individually involved, whether that's via board service or volunteering? And then, as I mentioned, family and how do you align some of these values with how your family is involved and how their values may be expressed as well. So really the most important thing that we talk to clients about, determining a capacity to give. And we'll often start here with understanding what someone's lifestyle spending is and creating a pool of assets that's going to be what we call their core capital, which is the amount of money that they need to sustain their lifestyle for as long as they live. Above that lifestyle spending amount, you know, you can create a hierarchy of goals. So whether it's annual charitable gifts, bequests to children and grandchildren, you know, maybe a one-time large gift for a capital campaign, we can add those hierarchy of goals into the equation and then determine how much of your total assets, total liquid assets, which we call surplus capital, is available to address those goals over and above that core capital number. You know, this core capital number is really dependent on someone's age, how much they spend, and how much risk they're willing to take in their portfolio. So an older client who is very willing to take risk needs less core capital than a younger client who spends a lot and is very unwilling to take risk for whatever reason. So that is something to keep in mind as we're helping people size gifts and size what they can part with on either an annual or a lifetime basis. Probably go through this slide and then maybe one more, and then we'll pause for questions, which is really, how do I optimize my giving with particular assets? So, you know, we often have clients and potential donors come to us with a whole host of things in their portfolios, whether it's cash, it's publicly traded, private business assets, real estate assets, tangible property, or IRAs. And ordering these from the simplest to the most complex sometimes helps them make a decision as to what's the best asset to give. I would say, you know, obviously cash is the simplest. It's very easy to write a check, but there is some benefit, obviously, in giving away appreciated publicly traded securities as we went through. And then other things like private securities or real estate can be very complex, requiring appraisals. Some assets might not be suitable. Debt could be problematic. Art can be very complicated as well. And so things to consider for all of these assets are really, we're going to have conversations with clients about, and we can help you have some of those conversations because we do have some in-house experts who can talk through the trade-offs here. then it really comes down to which strategy to use, and whether that is a purely philanthropic strategy because your sole goal is charitable giving versus the partly philanthropic strategy because your goal trends toward kind of balance between either a family member and the charity or a family member and yourself, is how we kind of divide the world. And so we may, for example, recommend, and today probably more than any other time, a charitable lead annuity trust for someone who gives annually, but also has a desire to potentially get money down to the next or further generations. And that is really based on the economics of where interest rates are today, and that a charitable remainder trust has a higher likelihood of success, or I'm sorry, a charitable lead trust has a higher likelihood of success than it might have years ago when you had interest rates sort of in the mid-single digits.
I was just going to say here, one of the things that we've seen, I love these trees, by the way. These trees are awesome. Whoever did the design of these trees, they're amazing. But we have seen absolutely an uptick in bequest conversations. So, and what we've heard from advisors we've been working with is people motivated more so than before to get their affairs in order. And the downtime caused by COVID causing people to be perhaps more reflective about priorities and trying to figure out how that is going to translate into their plans. That puzzle piece slide that you showed a couple slides before really speaks to what we've seen in the discernment process that we go through, sitting down with clients and advisors, talking through how to structure what their legacy plan will look like. And that's a thing that we've been in for some years now, and we've seen a significant uptick in realized bequests as well from folks who have passed on, but also an uptick in current conversations focused on mission and values and how and assets and what goes, to your point, for philanthropic purposes versus for other family purposes.
All right, so I think I'll pause there and see if there are any questions about anything that I covered or Mark covered. Questions for Peter.
Great. Please feel free to post any questions via chat to me or to everyone at this time. There was one question earlier in the presentation after Mark's section on investment. So Mark, the question is from Vicky Brackens. With the fact that we have such market concentration, 20% in FANG, how much pressure are they exacting on government to change policy to follow their underlying missions, social and business?
So I think there's two components to that. One is the ESG component. I don't know if the question's going that way. The other could be, what's the legislative risk in some of the size and scope of these companies? So we do think one of the risks in the FANG stocks is legislative risk, meaning traditional like antitrust type of rules, right? And that they've become so market dominant. Amazon's a great example, that in a new administration, could you have some potential breakup risk, like the old like Bell South, Bell Atlantics, the baby bells from many years ago? The answer in that is yes, there is some risk of that. I don't think that it's acute, but there is at least some risk to that. And when you think about owning these stocks, right, everything in our world is about risk and return. So the first risk is, do the prices of these stocks justify the underlying earnings? And one of the other potential risks is legislative risk. I'd also add the third risk is post-COVID. So this isn't like 1999, where there's a bunch of dot-coms that don't have real businesses. These are real successful businesses, but the valuation's in question. So I think post-COVID, whenever that might be, you could see a reversal where the traditional value stocks that haven't really done well for a decade do really well. And I don't think that means these stocks are down 20%. I just think they lag other parts of the market. So that's part one. Part two, if the question is more ESG focused, our company does run ESG only portfolios and then is a leader generally in the ESG space. And, you know, we're a large money manager. We've got over $500 billion in assets, and we do engage with the boards of these companies to talk about these issues and determine whether or not in a portfolio like our ESG portfolios, they make sense. An example that I can speak very briefly to is with Facebook. You know, look, we own a lot of shares. Mark Zuckerberg owns more, so you know we can't make him do anything. But we have looked at that company and seen changes in the board and some people who are more responsive to our concerns about ESG and governance issues, and we can voice those through people on the board. So it depends on the type of portfolios, whether or not we're going to be active in the ESG space or less so. I hope that got at the question. I'm not certain.
Thank you, Mark. Any more questions? Please feel free to post. We do
I'd just like to make a comment right here, Pragya, if that's okay.
Sure.
I just wanted to, you know, say the reason, one of the main reasons we do this event is just to say thank you to our professional advisors each year. And we noted that in the beginning, but I wanted to let you know about an added thank you in your follow-up email that you're going to receive next week. That was offered by the State Planning Council to have registrants of this continuing education seminar be able to attend as guests for the Estate Planning Council meeting on November 13th. It's the post-election presentation by Marion Fish on specific to estate planning with, you know, what we hope is results from the election by that time. I know, you know, November 13th may not, you know, have election results by that time, but we'll see this year. So, but anyway, we're really grateful to the Estate Planning Council for the partnership and grateful to the professional advisors that are on this call today. And this is just an additional, you know, thank you to attend that. So please look for that in the follow-up email next week.
Thank you, Tom. Peter, did you want to say some closing remarks as far as the topic here and this presentation from a philanthropic perspective?
Thanks, Pragya. First, I want to thank Mark and Tara for their presentation and their work. There's some really awesome slides in here that do a really great job of breaking down some complex issues, which I can say that I found personally quite helpful. And I think what we talked about today, there's a lot of synergy and flow between issues around investments and asset allocation, and then decisions around charitable planning and tax issues. And we've been in the center of a lot of those conversations. So hearing them all in one place is grounding and helpful as we get to what may be a chaotic time at the end of the year, but hopefully we're all moving forward in a positive direction and for the benefit of everyone in the community that we share collectively. We really want to thank you for joining us and spending some time on this lovely morning. And as always, we really do look to your feedback on topics and speakers and ways that we can bring value in collaboration with the Estate Planning Council. So thank you again, and I'll turn it back to you, Pragya, if you have any other closing organizational issues.
No, I join Tom and Peter thanking all the attendees and especially the speakers for offering your time. It's greatly appreciated. Now I'm going to end with some housekeeping items again. Make sure you fill out those forms because like Tom said, this is an appreciation event and we provide the CE credits that you need. So make sure, and if you have any issues, please feel free to email me or call me with any questions. Again, thank you so much, Mark and Tara. Thank you. Be safe in New York City there. Thank you. Thank you all.
Thank you.